Hello, everyone. My name is Sarah Bagley, and on behalf of all of us at Jones & Roth, I want to welcome you to today's healthcare webinar titled The Evolving Landscape of Healthcare Benefits and Insurance Strategy. Today, we have the privilege of hearing from Shelley Littlefield of Alliant Insurance Services. She's going to walk us through updates on the latest health insurance trends, how organizations are structuring benefits to stay attractive to employees, and much more. Please submit your questions into the questions area of your GoToWebinar menu, not the chat, but the questions section in the top right of your screen, and we'll do our best to get those answered for you. I also want to mention that the PDF with today's slides is available for you to download in the materials section, which should be next to questions. And before we get started, here's an introduction to Jones & Roth. As one of the largest CPA firms headquartered in Oregon, we serve clients across the Pacific Northwest. Our Jones & Roth Healthcare Practice Success Plan is designed to offer practice owners and administrators value throughout the year, not just at tax time, enabling them to maximize the financial and operational success of the practice, as well as the personal success of the owners through integrated tax, retirement, and financial management planning. You can find our practice success plan at jrcpa.com/healthcare. I'm very pleased to introduce our speaker today. Shelley Littlefield is Vice President and Division Manager at Alliant Insurance Services, located in Eugene, Oregon. She holds several industry designations, including Registered Health Underwriter, Chartered Healthcare Consultant, and Registered Employee Benefit Consultant. She has over 30 years of experience in the insurance and healthcare industries. Shelley, thanks for joining us today.
Thank you, Sarah, for the introduction. I really appreciate it. Thank you, everybody who can join us for this webinar. I'm going to go through my slides. Really want to just kind of do a really good overview about what is happening in the healthcare landscape. We're going to talk about some benchmarking specific to your industry, go through options around self-funding and maybe who should and shouldn't be looking at it, and then rally back and kind of talk about some strategies that other employers are implementing. As I go through this, I am going to take my camera off just so I can make sure I'm going through this, and then I'll get started. So at Alliant, we have a healthcare practice as well. Annually, we go out to our healthcare clients and customers that we service as consultant roles, and we do a survey and ask them questions about their health plan, challenges that they are doing, and then collect some benchmarking information. So I'm going to start talking about that. Our survey, again, it's national, so it's going to be employers throughout the whole country of many different sizes, some very large organizations, and then some smaller organizations. When asked about their concerns for benefit challenges coming up, of course, like most employers in our country, the number one was the cost of their health plan. Being able to control costs for the future and make it sustainable, 81% say that is their number one concern. Next, recruiting and retention. So we're going to spend a little bit of time just talking about benefit packages. Like I said, we're going to do benchmarking and talk about things when you're looking at full recruiting packages. Offering competitive benefits, communicating the benefits, and education. There's a lot of time and energy spent around benefits, communication, and education. Administration of the leave programs, as we're seeing many states migrate towards these paid leave programs, having legislative changes in their states, it is becoming a really difficult program to manage for employers. Wellness program and engagement. The benefits administration, just the task of administering those services, vendor management, compliance with legislation, and adapting to the post-pandemic work environment. So a lot of struggles that employers in the healthcare industry are faced with. So things about cost containment, so things that they're deploying or thinking about deploying or have deployed to try and stay on top of that healthcare or benefits trend and cost curve. High deductible health plans and HSA's #1 strategy to trying to maintain a benefits health plan that is affordable. So again, HSA's high deductible health plans. Telemedicine has been really heavily promoted and produced as a cost containment feature. Telemedicine is being rolled out for more than just regular. It originally started with primary care physician. We're obviously seeing that extend into specialty, mental health, and some of our healthcare groups and health insurance providers are moving into physical therapy around telemedicine and virtual. Prior authorizations around pharmacy programs, diabetic management. It's a very high condition for cost claims, so implementing disease management programs around diabetes, high on the list. Mental health services, condition management, tiered direct networking. Again, when you're in the space of being able to have limited networks and driving those to your home bases, a great implementation strategy to try and control costs. Doing pharmacy carve-outs, so really going out and looking at PBMs in the marketplace, making sure that you've got the best program available to contain costs. A lot more dependent eligibility audits, again, going out and making sure that you're covering the correct people that are supposed to be on your plan. Implementing spousal surcharges, so folks who've got coverage available to them someplace else at their employer, and implementing additional charges for those. Again, more narrowing networks. Claims audits to identify overpayments, specialty tiers, musculoskeletal, and other health conditions looking at point solutions. 80% of the organizations have implemented at least one high deductible option, and we'll talk about benchmarking in a moment, and you'll see some benefit features to that. So again, of those employers that have implemented high deductible health plans, 80%, when we look at the benchmarking data, 83% are offering some sort of a PPO plan, and 23% of the organizations are offering HMO. So again, probably in communities that have Kaiser options or other carriers that offer some sort of an HMO option. Of those employers offering those high deductible health plans, 76% of them do have an employer funding of that HSA account, so they are making a contribution. Median contribution for an employee only was $600. For a family, it's $1,100. Then when we look at just these median plan designs that employers are offering, you can see on the HMO plans, again, deductibles are generally nothing, so no deductibles. It really is the cost sharing around co-payment strategies. Out-of-pocket maximums are low at $3,500. Looking at office visit co-payments are very attractive, very good pharmacy retail co-payments. Then we look at the average gross cost and the cost sharing on the HMO side in this slide. So employees are paying about 14% of the cost as an employee only on the HMO side. On the PPO side, you'll see obviously they've got higher deductibles, some additional cost sharing to them. The cost sharing for the employee only tier in the PPO is running at 20% cost share. And then the high deductible health plans, the HSA qualified, again, the highest deductibles and cost sharing to the member. Their HSA contributions based off premium runs at about 15%. So again, strategies around what does the average benchmarking for the medical plans look like in this survey. So some cost containment features that they are either doing or have done or are looking at doing in their medical programs. When asked, 81% of the employers surveyed are doing self-funded health plans. So they have made the leap to self-funding, trying to get control of their healthcare costs through that feature. 14% were fully insured, and 4% were fully insured but had an HRA gap coverage to help subsidize some of the increased deductibles that they had implemented. So again, fully insured is the smallest percentage employers in that demographic. The current payroll deduction contribution approaches. So how are they structuring their cost share to the members? 47% of the employers surveyed are doing it as a percentage. So they're doing a cost share arrangement, 80-20, 90-10. So that as increases come up year to year, that is a cost share between both the employer and the employee. We've got 29% of the employers who had a defined employer contribution, so a flat amount that they are paying. So as increases take place, then the employee's portion is increasing at a higher rate. And then salary banding. And we are seeing this globally through our book of business on the rise. Employers choosing to do a cost share arrangement based on incomes. So those in higher income tiers are picking up a larger percentage of the cost. So reducing employer subsidies. So when we looked to say, okay, things that you're looking at either currently doing or are going to be doing, and we look at that reducing employer subsidies. 62% of the employers were either likely or are considering changing their employer contribution. So again, as a strategy to try and get on top of the cost of their health plan, the bulk of the employers are looking at that cost share to their employees. 70% of employers are looking or considering looking at alternative plan designs. So again, going back to that previous slide about deductibles, co-insurances, very high percentage of them are looking at changing plan designs as an alternative to control costs on their health plan. We've got a few who are doing the spousal surcharge or looking at it. And then introducing a narrow network. Again, networks are, again, a cost-sharing strategy, trying to go out and look at partnering with smaller networks to create greater advantages and savings to the plan. Again, another cost containment. We talk about this a lot. It's been going on for the last several years, or the GLP-1s. When asked, employers, 39% are currently covering it for weight loss. 35%, however, are considering it as a future coverage. So a lot of employers are looking at adding this as a method for weight loss treatment. We do recommend and are seeing that most employers are implementing some sort of utilization management program, however, behind it. Prior authorization is the number one. 96% have some sort of an authorization process. Having quantity limits, so supply limits. Mandating a participation in a lifestyle management program. We've got some folks doing that. And then again, kind of through that prior authorization program, they're looking at BMI requirements or some sort of obesity indexing. So again, not just opening it up to everybody, but implementing some sort of a strategy around controlling those costs. So talking through employer sizes, because of course, in our industry, there are lots of different sizes of employers, and the smaller physicians groups or even the smaller hospital systems in rural areas sometimes do have a hard time competing against the larger health systems. So we always try to focus on, what is it that we can do and what are the things that you should be looking at when you're trying to stay competitive in not just the health plan, but recruiting, retaining, and keeping your employees. Areas where kind of smaller physician groups or health systems are more competitive or at market would be salaries. So we find that the salaries are near market in the median, and that they're doing the sign-on and relocation support, so sign-on bonuses and relocation expense coverage. They're covering medical recertification, so continuing medical education is an allowance. And they're doing basic PTO allowances. They're doing productivity-based upside. So again, incentivizing based on outcomes and productivity, their pay. So those are things that we see very competitive even in the smaller physician practices. Where we see some inconsistencies, again, is that employer premium contribution, really tough as the smaller employer to keep up on that contribution strategy compared to a larger system that might be in your community. Making sure that you're looking at the retirement match depth that you're doing. So again, as employees are coming to you and looking at a full benefits package, looking at that retirement benefit match. Student loan or debt support, another big one that is in the recruitment portion. And transparency about total rewards, really around the communication. I'm going to talk about that several times throughout here, but communication seems to be key. The hardest part is spending the time to really make sure you've got a good, effective communication around the benefit strategies that you have. And very common gaps, again, where we see most commonly where their spread's going to be, again, that lower employee cost burden when it comes to the benefits packages, whether that's premiums, deductibles, things that are costing employees. Larger health systems or employers are going to have a broader plan choice, not just meaning the number of plans that they offer, but the ability to offer different carrier choices within their platform. So again, that is a tough one that we see hard to compete with. They are really in a better position to do retention focused and long-term incentives. So again, as something an employer can be looking at who maybe is on the smaller side, retention focused incentives are a great thing. And perceived stability and brand signal. Again, some things that are really hard to overcome when you're trying to compete with those big systems. Some other dynamics for healthcare groups, cost competitiveness, really things to continue to recognize because they do make it difficult. Compensation inflation. In 2025, compensation on average was up 4.9%, so almost 5%. Really hard to continue to stay on top of costs when we know that we're having to compensate at pretty significant increases. Ownership scales for, again, smaller medical practices or groups. Physician-owned practices are a bit of a disadvantage. Really difficult to compete, trying to do things at scale, just harder to negotiate those things as a smaller practice. And then candidate expectations. So candidates are coming in educated. A lot of times they've got multiple offers or they've got choices. So they're, again, looking at sign-on bonuses, debt support, these premium shares, retirement matches, all the things that we kind of talked about on the previous slide. So things that we've got to be looking at and continually thinking about when we're looking at recruiting and retaining. So operationally, again, we know that we've got physician shortages. They've got increased bargaining power, so trying to figure out how we can get physicians to come work for us. With rising healthcare costs and insurance costs, hospital systems leveraging scale for richer benefits, and candidates being able to compare the total economic value. So again, I go back to knowing that these are concerns that we're dealing with, making sure that we're educating and trying to come up with packages that are all around attractive. Might not be able to compete in one area, but really trying to create plans for recruiting. Again, and what's going to happen if we don't address some of these issues? Going to have higher decline rates, hard to fill positions, especially for the specialty groups, more counter offers, really retention erosion, which is extremely expensive, being able to recruit, get someone to come work for you, and then they leave within the first couple of years. Reducing recruiting efficiency, again, making sure that we're not having to do so much search, keeping our vacancies are open longer, that's just costing money. So things on the watch list of metrics, again, really important to make sure that we're continuing to look at. Looking at your offer acceptance rates, targeting 80 to 90% acceptance rates. Now that will be lower if you're trying to recruit really specific specialties. It would be expected to be lower than that. How long it's the time to fill by specialty. So how long is it taking us to fill our positions, making sure that we're working on trying to close that gap. Again, keeping physicians in the seat, making sure that there's not turnover for them, making sure we're constantly looking at the premium share versus the local competition through benchmarking, making sure that you're staying competitive. And again, those sign-on and retention bonuses, really thinking through trying to keep and retain folks. We talk a lot about not just the sign-on bonuses, but those bonuses and retention for folks who've been working for you for a long time. Again, kind of a recap slide, re-benchmarking the full offer, just really making sure that you're looking at your salary competitiveness, sign-on bonuses, those premium shares, all of the things that your employees are very educated about and are looking for when they're looking to come and work for you. Lower visibility on the employee burden. So again, trying to mitigate what their impact is out of their pockets via health plan options, premium equivalents, targeting those scarce, especially thinking through your recruiting ability to get those hired, more difficult specialties. You have to look at them a little bit differently than your average employee. And again, tying money to tenure. We talk about this obviously in the industry we're talking about, but really through lots of our other industries that are, again, having some of the same problems keeping employees in the seat. And then improving your offer transparency. Again, it goes back to showing them what your package is and what the true value to coming to work for you is. So again, bottom line, you can be competitive even if you're in the smaller marketplace. It really takes that strategy to try and create something that you can show the employer the value that you bring not only to them, but that they're going to bring to you. Making sure that you're looking at the best talent. Differentiating requires design. So again, it's not just about spending more money, it's about this communication tool. And then leadership needs to be aligned. It's critical to the execution of your plan for recruiting and retaining employees. So very important to have complete buy-off on that process. So going kind of back to that survey that we did and looking at the employers in the marketplace, and we saw on that slide that 80% of those that we surveyed were already self-funded. So again, a high number of them, and really it has become a very popular and really well vetted out option for employers because we are seeing such increased costs on the health plan side. It is generally, health insurance is a line item that the CFO is most commonly feeling that is out of control. We have the least amount of control over it. Got to be looking for ways to eliminate the waste to maximize the efficiency of the benefit dollars that have been budgeted for and deployed. And in most cases, it's the easiest way to eliminate waste and spend because you gain all of the profit and have more control of over the decision making of the benefits that you're going to implement. So next steps, if you're not self-funded and you're looking to be self-funded, it really comes down to analysis and it's about data. And a lot of what we talk about in the health insurance landscape these days is data-driven. We've gotten a lot more sophisticated and able to really look at numbers and do projections about specifically self-funding marketplaces, network strategies. And really it's trying to retrospectively look at your historical claims, look and see what you've been paying for fixed costs, seeing what your current fully insured premiums are and how those are broken down by your current carrier. And then really prospectively looking forward and estimate what we think the claims for the future will be. Trying to model this and make sure that we are getting folks into the self marketplace that really look like there are opportunities. I get the question a lot. People think that there's some magic number. What size do I need to be self-funded? And there's not really a technical size. It really comes down to the employer. There are a lot of disadvantages and advantages to self-funding we'll go over in a minute. But what we generally see is employers who are currently receiving claims experience from their current health plan if they're fully insured have the best opportunity to be able to do those retrospective and prospective case studies because we do have claims data from your insurance carrier in most cases. Employers below that size, it is more of a guessing game. So we do have to rely on the actuaries a little bit more. And there is more fluctuation in what the modeling can do. So again, we generally see employers over 100 lives moving to the self-funded, but there are other products in the market designed for those employers under 100 lives that can help them make some gains into the self-funded world by doing things like level funding, which we'll talk about a little bit as well. So not necessarily a size employer, but it is generally for those employers over 100 lives. So a kind of an illustration about financing, right? Where are my dollars going when I pay a fully insured carrier? We are obviously purchasing health insurance because we have medical claims, and we're going to pay medical claims whether we're on the fully insured market or self-funded market. What we do tend to see is we are able to align employers by looking at their data with the best networks available in their areas. So we do tend to find that we've got some potential savings in the claims by making sure that we've got the appropriate networks in place. When you're looking at the self-funded with stop-loss model, you're going to notice right above claims on the fully insured versus the self-funded, there are no mandated benefits. So some of this savings, that 11 to 15% savings opportunity, does come from avoiding having to cover state mandates. Now, you may choose to add some of them back in, you may not, but there is definitely savings to not having to do those mandates. We do pay for what are called fixed pooling charges, and in theory, those are your stop loss charges that you're paying your fully insured carrier. You are going to generally, depending on the size employer you are going to be paying stop loss premiums. There is a lot of opportunity in the marketing of stop loss premium or stop loss contracts. We have a lot of great features that are out there and a very robust market right now for stop loss. So there is potential to save in those premiums. Administration, you should definitely be seeing savings in the administration and bundling of your services. So there is opportunity for savings. There is no profit to the insurance company in those administrative fees and services. So there is savings there. Insurance company profits, when you see those on the self-funded side, those are profits through the stop loss premiums that you are paying. So they are less than what we're paying on the fully insured market. Premium taxes, again, another tax that we get to avoid or mandate. There are several premium taxes that you avoid when you move to the self-funded product line that you're not having to pay like you are in fully insured. So again, definitely some lower administrative costs and ability to save money off of claims moving to self-funded. Other things that you're looking at when you're moving to the self-funded, I will tell you, one of the things we talk a lot about to our clients is there's a lot of education around moving self-funded. The great thing is you are going to have a lot of tools and market resources to take advantage of in the self-funded models. But that does take time and a commitment. So before an employer is going to move into the self-funded marketplace, we spend time really talking about who the team involved is going to be. It clearly needs to be the CFO. This is a huge financial transition, and there is a lot of management that has to go on long-term when looking at the claims for your self-funded plan, but it also takes a really good benefits team to make sure that they're looking at services available to them. So again, sophisticated folks for the self-funded marketplace, looking at things like pharmacy carve-outs. Again, PBMs, there is a lot of strategy around what you're currently paying for and PBM relationships that we can go to market to try and eliminate waste and save money on those cost strategies. Obviously, pharmacy trend is outpacing medical trend. Very important for us to stay on top of this. One of the #1 cost drivers for healthcare spend is around the pharmacy world. Specialty drug costs are making up 50% of all spend for pharmacy. And only 2% of members are utilizing that benefit. So again, very important to be collecting information on your pharmacy. When you move to the self-funded world, it is going to bring a lot of advantages in reporting to you. So again, lots of ways for us to be able to advise our clients in these strategies and ways to save money. Looking at alternative network solutions, again, we'll talk a little bit about reference-based pricing in a minute as an option. Employers are moving to that. We have historically seen that around dialysis management and the cost containment of that benefit, but we are also seeing it as a network solution for employers. And again, the narrowing of networks, really trying to get into some risk contracts with medical groups or providers' offices that are willing to partner with employers. Point solutions. So really going out and looking at ways to create things within your health system or health plan to make the benefits either more available to your employees through well-being programs, specialty conditions, behavioral health, some chronic disease management that we can carve out. So lots of point solutions that you can align to try and get on top of the management of your claims for these self-funded plans. Looking at a captive. So captives have become very popular over the last really 5 years, but they can be a way for you to partner with a third-party administrator really to help reduce the volatility, especially for employers starting in the self-funded marketplace, or maybe are in a higher kind of risk tier as employer. It can help share risk among other employers, so you're really getting buying power through this vendor, partnering with other employers. So some of the disadvantages in self-funding. So as I said, there's lots of upsides financially we generally find to it, but there are definitely some disadvantages of self-funding. It is not for every employer. So you're going to assume a portion of the risk, and that risk can be volatile. It can be very up and down. When you move to a self-funded plan, ideally you'd love everything to kind of be over a 12-month time period, but it doesn't work that way. Sometimes the plan is incurring substantial amounts of risk in the first quarter, and you've got to have enough cash flow to be able to manage those ups and downs. So again, making sure that you understand what the risk for those plans are. If you hit the maximum liability in a year for your self-funded plan, meaning you're hitting your stop loss limits, that is usually going to be a more expensive option to you than having a fully insured plan. So really making sure that an employer understands what the upside and downsides financially are to moving to that model. Again, the claims fluctuation is going to be an up and down. So it's not a fixed premium like what you're used to. So again, managing that cash flow, making sure we're getting plenty of reserves built up, and making sure we're making the plan healthy. One of the bigger ones I think employers don't think about is the liability for decision making. It is really important, especially if you're in a ERISA plan. You've really got to have very well thought out decisions around making exceptions. You know, when you're on a fully insured plan, your insurance carrier approves, denies things. Employer might not always like the decisions. Sometimes we'd like to jump in and say, hey, it would make more sense if the plan would cover it. In the self-funded marketplace, you do have that option. You are the final no. You're the final say, but you do need to make sure that you're creating a lot of really good standards around those decision-making processes so it doesn't look discriminatory. So there's some responsibility for your team around that, and making sure that you're really meeting the full requirements of HIPAA. Making sure you've got policies and procedures in place. Again, most of you are in the business. You probably have a lot of that set up, but really important to make sure that we're careful with the data that we're receiving around that health plan information. And it's a long-term commitment. Again, making sure if you're moving into the self-funded marketplace, that is really a 3 to 5 year commitment. Got to have a long-term strategy around that plan, because in any given year, it can be unattractive. So getting into that market space is difficult. Getting out is twice as difficult. So if it isn't working out for you in self-funded and the risk feels too high or just too complicated, moving out of that into the fully insured marketplace again is a big decision and really has to be well thought out. So again, it's a commitment. Increased compliance and plan regulation. Again, there's going to be more things that you as a self-funded employer are going to need to comply with. So again, making sure that you've really thought through those strategies and have a team in place to be able to manage those things. So again, advantages. There are advantages. Again, escaping the fully insured risk pool. So getting out of that carrier, looking at yourself, being able to stand on your own as far as paying for your claims and just worrying about where you are, participating in good claims experience. So again, really taking advantages. Our carriers do not generally share in years when you're having good years. You're not generally getting the premium reductions or help that you would get when you're self-funded. There can be cash flow benefits. Again, if your plan's running well, the cash flow will be positive for you. You're not putting out those fixed premiums every month. You're getting to keep those dollars in-house. And again, full disclosure of claims data through advanced reporting. I can't say how important that tool is for employers who go self-funded. It is one of the, I think, best advantages just for the long-term health of your plan, really being able to work with your broker or consultant to get advanced reporting to understand where the dollars are going. Risk management through stop loss. Like I said, there are a lot of great contracts out there for stop loss insurance. So getting to leverage your expenses in the best way that for you, not just the insurance company. Eliminating the premium taxes, again, a savings, administration tailored to you and what your employees needs, benefits that are important to you. Control of the plan, and again, the elimination of state mandates, all really great advantages to self-funding. So again, for those employers thinking about moving to this or really wanting to research it, I think it's giving yourself like a 12-month landing page of collecting information, looking at your claims data, and then getting some options to really look at that analysis for you.
Say, Shelley, we've got a
Yes.
question.
Yes.
Are physician groups or clinics starting to offer an individual coverage health reimbursement arrangement, ICHRA? I've seen other industries offering it.
Great question. ICHRAs, the new acronym in insurance. I will say the marketplace, we'll talk specifically to your industry. I have seen very, very small amounts of folks in the healthcare industry offering ICHRAs. I could put 20 slides about ICHRAs on here. We have implemented many of them. In most cases, the employers that we are seeing move to those plans are employers who have risks within their health plan that they can't get enough premiums collected. So they've got really poor claims experience. They're outpacing medical trend 2 and 3 times. Their contributions cannot keep up with the cost of their health plan. So that's who we tend to see go most commonly. It's been our nonprofits who have actually moved to that. There are multiple negatives to moving to an ICHRA. When you move to an ICHRA, although it is an ACA qualified plan and you can still meet the ACA requirements for contributions and plan designs, it absolutely takes the group health insurance advantages away from you as an employer. You no longer have the ability to manage eligibility like you do currently. If somebody doesn't enroll, they make a mistake, they pick the wrong plan. There is nothing the employer can do to help them get insurance during the year. You have very narrow windows of time to get new hires on. So my recommendation, anybody looking at ICHRAs, which we do model that frequently, there are a lot of great modeling tools out there for employers to look at, just how does it meet financial goals for you. But you really need to go through the disadvantage slides with your producer or broker because there are many. It really, for us, tends to be kind of the very last ditch effort to trying to keep some sort of a plan for your employees. Great question. So slides, I'm going to go through these pretty quickly because they are going to be in the presentation slides that you can get from here, but really going back to the benchmarking, I just wanted to let you know as what our healthcare survey did, what kind of benefits that other healthcare organizations are offering. Again, not as high on the cost lists for employers, but still very important when you're looking at employees. Again, dental and vision benefits, very popular, fairly inexpensive, but 83% of the employers surveyed are offering some sort of a dental and vision program. So here's some of the median offerings that employers are making. Short-term disability, again, we're seeing lots of state mandates implementing these paid leave programs. So I would say if you're in a state that's got a paid leave mandated benefit through the state, that short-term disability benefits would really only be offered if you're looking at your average salary and you're seeing that employees are not being able to round out or not being able to be compensated enough through your state's paid leave, that a short-term disability benefit may be helpful for them. Again, for the folks who are maybe in higher income brackets. But again, short-term disability benefits being offered still by employers. Long-term disability benefits, again, a very important benefit being offered. Again, average benefits that employers are offering. We've collected who the most common carriers are or insurers for this. Surprisingly, in the long-term disability market space for this employers that we were, 42% of them were self-funded with some sort of a third-party administrator or carrier helping manage them, 50% in the fully insured marketplace. Life insurance, again, employer paid benefit. Largest percentage of employers are offering 1 times annual salary at 53% of them. Again, we've got the most common carriers here. Most employers, or excuse me, 100% are offering some sort of a base life insurance, 96% offering voluntary life. So again, voluntary life, another great way for you to offer a benefit strategy that doesn't cost the employer anything. Offering those voluntary plans are fantastic, giving employees the opportunity to keep them. And again, that's a great one to continue to communicate to them. Time away from work programs, again, we're seeing these elevated, very top on the list for employees when looking at their offer packages. What kind of paid time off and vacation, sick leave benefits do I get? So I'd really think, again, if you're a smaller employer specifically, great ways for you to make it attractive for employees. Jury duty, of course, 90% are being offered, 95 for bereavement, 64 for personal leave. So again, gives you an idea of what employers are offering, and then what those who aren't currently offering it, who's planning on considering it for the next year. Trends for work environment, again, just things to think about while you're in that recruiting mindset. Course, in the healthcare focused businesses, for folks that are patient-centered, it's not going to be available to be able to do a work from home. But for those employees who are not necessarily have to be, we've got 18% offering hybrid work environments, 11% are work from home. So if you've got positions available that don't have to be in the brick and mortar, people are loving hybrid and work from home schedules. So well-being, another one we've talked about, they call it now kind of well-being, but it's really those wellness strategies or offerings, the kind of feel-good benefits that are being offered. 80% of the organizations that were surveyed are covering some sort of a wellness program. They've got something in place. 57% of those employers are doing it primarily to reduce healthcare costs. I will tell you, return on investment for this is really difficult to track, not impossible. It depends on the matrix and how you've set your plan up. But I really do talk about these. They are important, but they are kind of more strategized around those feel-good benefits. Let's share my slides again.
There we go. See the slides. Thank you.
You betcha. Again, talking through the wellness programs, we will move to the next slide so we can stay on track. I apologize. And again, other holistic programs, employers offering, just great things to keep in front of you, kind of looking through your packages. Financial planning, again, very high on the list. Helping folks with their retirement planning, making sure you've got a great partnership in that. Doing community services, again, reaching out to the community, volunteer hours, volunteering events. Ancillary insurance products, again, things that don't necessarily cost the employer dollars, lots of accident, critical illness types of insurance products, entertainment benefits, programs like Life Balance, or programs that allow discounts for employees, career benefits around tuition reimbursement, the number one. And again, new parents are flexible work schedules, important for them to have time at home. So strategies that larger employers are looking at, again, we've kind of talked about self-funded, we've talked about data, how important that is. And we are seeing a lot of momentum with companies. I'm not sure if folks are familiar with Gartner. Gartner represents about 75% of the US medical claims data they have in their database. So they have identified through their national database high-performing physicians who deliver healthier patients and lower costs. So Gartner, through their information that they're collecting, they collect that information from CMS, commercial insurers, self-funded, other public data sources, and they put that information in a geographic region where you may be located or your population may be located. They will pull together employers that they view to have those healthier patients and lower costs through better outcomes. They present that to an employer through websites or mobile apps for employees to shop for those top performing physicians. So trying to migrate patients to providers that are generating lower costs to the health plan and creating healthier outpatient or outcomes for the members. Again, kind of new. Our health plans themselves have been trying in some fashion. We've had United Healthcare and other carriers trying to do this, but Garner is now one of those vendor solutions that you can partner with. Most commonly, this is going to be for self-funded employers or larger employers. Plan designs. Why would we pay for a vendor solution like Garner? What would that bring to the table for us? What could we look at? And a case study that was put together with Garner was an employer who was receiving a 20% increase on their health insurance premiums. Their current plan design, office copayment deductible, and per employee per month cost, 20% increase. They could adjust their medical plan by implementing a major medical high deductible $4,000 deductible plan. No co-payments, just straight deductible of $4,000. And that would get them to about a 2% premium reduction. If they implemented the Garner tools, implemented that program, pay Garner to do their data matching and bring those providers to the table, they could change their plan. It would still have a $4,000 deductible to it. However, for employees who chose to go with the Garner providers, I call them the platinum providers. You go with a Garner recognized platinum provider, your deductible goes down to $2,000. Your copayment when you access those providers goes to zero. And that plan design is about a 1% increase versus the 20% increase. So they're showing about a 19% savings to implement Garner data and providers into this health plan as a solution. Garner's grown quite a bit. Again, started in 2019, no clients, up to 800 clients now. Here's a list of some of their top employers that they're working with. Again, a great strategy for employers really trying to get into their data sources and really figure out how to steer employees in a direction to keep the cost of the health plan down, but again, have better outcomes for their employees. So again, one type of a solution that employers are looking at. For employers who maybe aren't of the size where this tool makes sense, because again, this is really for large employers with access to their data. Again, we're seeing similar network management systems. Our carriers, really Pacific Northwest, United Healthcare being kind of the one leading this, they have historically gone out and they've promoted what they consider to be their top starred providers in an area. And they have sold a few plans around those types of providers where there were some incentives, but they're really pushing for 2026, 2027, these value-based benefits, meaning you go to a United Healthcare plan, you buy a value-based plan from them, and co-payments to employees who choose to see those top providers, again, outcomes, health plan expenses overall, go down to, in some cases, zero, where there is no cost sharing to the member if they choose to see one of those providers. So again, really this network management is top of the list for 2026-27. Regents is also looking at a value-based benefit system. And as I had brought up in the slide around self-funding, talking about reference-based pricing, really reference-based pricing has been pretty competitive in the state of Washington. We are seeing it, and some of the other smaller states, Idaho, Montana. We are seeing those plans come down, Oregon, California, really rolling out in other areas. And their entire platform is around full reference-based pricing. So again, you go to a carrier, you offer the reference-based pricing plan, meaning there is no network selection for employees. They're allowed to go to any provider who will accept their health plan. It's based on a percentage of Medicare reimbursement. Employer, depending on the size, has some discretion around what that percentage is, but employees go out, they have their healthcare services, depending on the vendor that you pay or have managing this plan. They have services to help negotiate with providers. If your provider is unwilling to take the fee that your plan is paying them, they've got financial folks who will help negotiate those fees on their behalf. So again, as somebody who's in the business, those folks attending this, you may start to see more of this reference-based pricing from employees or members who are coming to see you as providers, and is also an option for you to look at. We see about a 20%, up to 30, depending on the type of claims, savings off of claims by moving to that reference-based pricing based on obviously the reimbursement based on Medicare instead of those PPO contracts. So again, strategies really around the healthcare management are around network management as well. Again, small employers who maybe don't have those self-funded plans, we have multiple carriers doing level funded, which is really a more managed type of self-funded. It gives employers a way to be in risk management with their carrier. So if you are performing well, there is some cost savings. So the carrier will either credit you through claims, so write you a check, or they will give you discounts off of their administrative fees for the next year. So again, trying to be in that business of sharing in the good years. And level funded can help mitigate those big peaks and valleys as far as the claims go, because they are billed on a monthly basis. So your monthly output is the exact same. It just gets reconciled at the end of the year. And if there is a cost share available, meaning you performed well, they reimburse you that next year, and you don't have those high peaks and valleys. So again, looking at level funded, really important. If you're a micro group or an employer really small, sometimes those level funded plans do require health statements. I know most of us haven't been in that business for a long time, but some of these carriers do have some size requirements around those products. So if you're too small, sometimes those health questionnaires are an obstacle to be able to move forward. And questions from anybody?
I don't see any at the moment, but if any come in after the fact, I'll be sure to send them along to you, Shelley, okay?
Thank you.
All right.
Thank you,
Well,
everybody.
yeah, Shelley, thank you so much for sharing your expertise with us today. Everyone, take care and have a great weekend.